good morning, everyone. It's on this sunny Friday morning. It's sunny here. I'm in downtown in Melbourne, and the sun's shining out there. So wherever you are in, in Melbourne or across the state, thanks for coming forward to seeing this financial plan, which is probably an extension of what we did before, I guess, in terms of the webinar, the LGB webinar we had. So there seemed to be a bit of demand and an opportunity for to provide a little bit more information in relation to the financial plan. Now, just talking to Gab, we're going to make this as a, and I'm sorry, Gab, I've got to give you so you can press the go button, don't I? And then and start your video. So just as a bit of background, you know, this financial plan, as we know, is one of the mandatory documents we need to have. And you know, as we know, we've got the budget at the same time, and we're also doing the revenue and the rating plan. So there's obviously a lot of things going on. So the purpose of this is just to try and give everyone a little bit more information on probably how to complete the financial plan. It is very new. There are some councils we know that do a financial plan. But it is very, very new for some people and from others councils. So with that, Gabby, you're right. I'll make a start if you like. So completing the financial plan, we've allowed probably up to a maximum, if subject to people's availability, an hour for this session, so from 9:30 to potentially 10:30 latest. Happy to take this interactive. So if you've got questions, I think Gabs, is going to help me out, and I'm happy to take those as you go, or have this as a fairly informal session. The key thing on the adoption is the roadmap in terms of when we need to adopt a financial plan. Some councils are going to do this by the end of June and adopt at the time of the budget. The others is the last date, of course, we can do that, you might be aware, is the 31st of October. The June date, generally speaking, although this is not mandatory, but generally speaking, we'll align those numbers with the 4-year budget with the 10-year numbers in the financial plan. So generally, I think the intent is that for a lot of councils, we'll do the 4-year budget numbers, or the first 4 years of the 10-year financial plan will be in the budget, and obviously then the 10-year model in the financial plan. I do know that some councils are going to look at an October adoption, because I understand their proposal is then to look at, well, what would happen if we adopt our budget by the end of June? We may want to make some other initiatives and other changes, and we'll then have a financial plan adoption by the latest end of October, which might have some more initiatives and will be, I guess, an advancement on the budget. So the key things you need to consider is timing for that adoption, particularly in the context, and I'll cover this a little later on in terms of a community engagement policy. Some councils have adopted their policy at this stage, which my understanding is if they do, they then need to have some sort of community engagement on the financial plan. Others may not be up to that stage of adopting their community engagement, and they're doing if you like, essentially what's a Section 223 process, but it was under the old Act. So it depends upon the level of community engagement, and then obviously the timing for those other documents. The format of this is, I've colour-coded on the right-hand side, and just to give you some context behind why we structured the financial plan template. Again, some councils are at that stage of it, but are going to use different components of a template. But the intention of a template, there's 3 colour-coded sections. Essentially, the green section in the middle of the financial plan statements and performance indicators, as we know, are essentially the 10-year model of a 4-year budget. So for those councils that have already got a 10-year financial model, they'll take their 10-year model. Ideally, then they'll drop it into the financial plan, take the 4-year numbers, first 4 years of that, and the 4 years plus, of course, the projected actual. So say 4, it's really 5, isn't it? So we've got 2021 forecast, and we've got 21-22 budget, and then the 3 next year's budget. So that's the years, of course, we'll take out of the 10-year model and put into the budget. So you'll see that the financial plan statements and the performance statement in the financial plan aligned to the adopted budget. So they're the same numbers. So what's new? So that's the consistency, at least that's the section where there'd be no surprises to people. The sections that are new, and I'll go to this section 6 and 7 first, which is a borrowing strategy and the reserve strategy. Some councils that have already got a pre-existing financial plan, they've covered off and covered that, well, before we had this mandatory compliance requirement, included borrowing, and they included reserves, and they also included things such as rates and revenue, and assets and services. Now, as we know, and by design, rates and revenue, there's not a lot of commentary in relation to the financial plan in this document, because we know there's a revenue and rating plan, so we didn't want to double dip. Pre-existing long-term financial plans have had an asset component, and as we know, there's a pre-existing, or there will be an asset plan, and there'll also be service plans. So the intention on this financial plan document was to cover off on those components that are not specifically covered in other documents. So that's why we've landed on a component of a borrowing strategy and a reserve strategy. The first three I'll go to last, because of course the policy statement and strategic actions is a bit about what's the strategic intent, because at the end of the day, the financial plan is meant to be a policy, like a strategy document. Yes, there's some compliance components, and there's a lot of boxes we need to tick for compliance under the new Act, but it's also meant to be a strategy document. And the inclusion of a policy statement and strategic actions to talk about what's your council's strategic intent, and what are the key priorities which you identify that the council will sign off on and say these are our key priorities for a financial plan. The assumptions for financial plan statements is just to give a reader a commentary as to know about the escalation or the other assumptions that's built in on the 10-year model. So that's the further content. So I'm going to go through each of those from 1 to 7, and Gab, I'm just going to keep rolling through this, but if you're welcome to, or anything, welcome to interrupt me or comment if there's any questions. So financial policy statement, strategic actions. So I'll put them together because there's a bit of overlap between, this is my interpretation anyway. Financial policies, and you'll notice in the financial policies, what we've tried to actually do is included some actual numbers in the policies. So I've just put it in a later slide. So you'll see there, that's the example. And again, these are only examples of financial policy statements, but we've put it in a format so that you can actually have a measure and a target. As we know as accountants, we're pretty good at being able to measure things. So we've put actually a target, and a 10-year target, a 10-year number to demonstrate what that policy intent is. So going back to this slide, I put this policy statements and strategic actions because there's some correlation between the two. So financial policy is what your council wants to achieve. For example, so this is just one of the examples that we've actually put in the template. It might be to allocate adequate funds towards renewal capital to replace assets in infrastructure as they reach the end of the useful their service life. Now, that's no surprise about, as we know, about the infrastructure gap and putting funds towards renewal capital. So that's the policy statement or the intent that council will do that. How we know if they're doing that, one of the measures, as we know, it's only a high-level measure. It's one of the VAGO measures as well, asset renewal and upgrade over depreciation. Now, I put there as a measure of greater than 100%, so that's ideal. I think most councils can get to that. Perhaps not every council can actually achieve that measure. So that's the policy statement. What's the intent you're trying to achieve? The strategic action, on the other hand, is what they're actually going to do to achieve that. So again, just an example. preparing a long-term financial capital works program to contribute council cash rate subsidy, or some people call it the council cash contribution or the rate subsidy, is prioritised to renewal work. So it's other words, often the councillors would prefer to allocate funds to new works because they're a little more sexier than fixing up existing assets and replacing road works. However, in order to manage the renewal infrastructure and renewal works, it's about allocating those funds to renewal works. By putting that into a policy statement as intent, getting the councils to sign off on, probably again gives the organisation of council a bit more traction on, councils, this is our priority to renewal over new. So that's an example of where, and we have in the document, in the draft document, the template, some examples of financial policies. They're not the be all and end all, but they're examples of financial policies, and then some strategic actions. That is, what are we going to do to fund those policies? So that's the relation between those two. Again, financial policy statements. You can see that on the screen. So that's, I'm assuming everyone can see that pop down, so I apologise for that. So in the policy statements, I said we've seen an example. What's actually required? So it's an explanation of a financial measure that underpins each financial policy statement. So we're actually going to have a measure, as we said, in the case of the asset, it's the renewal and upgrade over depreciation, and then we set a target that's designed as a measure. Ideally, in the case of the renewal and upgrade, it would be 100%, for example. It might be more than that. Then we can do that with the 10-year calculations for each financial measure, and we compare that to the target. So that's all about demonstrating financial sustainability. So on the next slide, you'll see that we've probably covered it in one of those. Again, the third one down, allocate adequate funds towards renewal capital to replace assets and infrastructure and reach the end of a useful life. Again, there's the measure, asset renewal and upgrade, over depreciation, target is 100%. Again, this is just an example, a guideline. Minute saying it would be 100%, and saying that it's what your own council's position is for that as a priority, if that is, for example, a part of your strategic intent or policy. Again, if that was to be 100%, then it's about demonstrating what's the number when you actually drop that number in there and you do that calculation. Again, this is an example of a calculation you're probably already doing because it's a BAGO measure as well. It'll actually give the whatever the percentages, you obviously haven't calculated there, but ideally you would hope that whatever the numbers are in your 10-year model will actually be more than the 100% or around that, or the target, to demonstrate that that's a priority. So that's the example of a policy statement. Again, I think I've just repeated there what those statement examples are on the previous page. It might be, again, examples only, consistent underlying surplus results. It could be ensuring, as well as maintaining sufficient working capital, meet DOL level code. That's always a good idea, paying the debts, as we know. That's the one on renewal capital. Loan fundings, if your council has an appetite for new loans. Loan funding, and again, a lot of councils will have a pre-existing borrowing policy. Then whatever's in consistent with your policy statement, you might want to include here. Loan funding to new capital, maintain total borrowings in line with rate income and growth in municipalities. So in other words, because of course the debts or loans are generally secured against the rates, as rates increase, albeit very slowly of course because of the rate cap, as we know, it does generate a little bit more capacity for borrowing. Maintain sufficient unrestricted cash to ensure ongoing liquidity, address unforeseen cash impulse. So it could be putting money aside in the reserve, revenue, or again, these are just examples of policy statements. Generate sufficient revenue from rates plus fees and charges to ensure a consistent funding for new and renewal. Now, this is just a variation on the renewal over new. Some council may have a pro to say, well, we want to focus on both, and we want to have a policy on X amount of dollars or percentage of surplus out of the rates or from operations to be allocated towards new or renewal capital. So that's the first one. So again, going back, you'll see it's policy statements is the first key area where we're covering off here. Again, that's the example of the policy statement. So that's the example of a template. And the reason we've put it in terms of and some numbers, because it's probably because we're doing this as accounting practitioners. So by putting policy statements in that form, it probably just makes it a little easier rather than have a policy statement that has a lot of words. You can obviously do that as well, and a lot of commentary. By putting it in terms of the numbers, it actually gives a way to measure and demonstrating that if we're achieving the target, then hopefully you'll be achieving a policy intent. Okay, I'll keep going on. Second one, strategic actions. So I mentioned before, and we'll just go back and just redo this, look at this again. Again, as said, link between financial policies and strategic actions. Policies, again, what your council wants to achieve by the policy statement. Strategic actions is what are you actually going to do to achieve the policy statements, or what are your strategic actions over the strategy. Again, often these strategic actions, again, this is all in the context, of course, for community vision and the council plan. So the idea of the funding, of course, of the 10-year financial plan is to be able to give the context behind achieving the community vision, achieving the aspirations of the projects or the priorities in the council plan, but what do you actually need to do from a funding point? So this is strategic actions from a funding point of view. In the case of, in this example, of prioritising renewal works as an example. So back to strategic actions. I'll put this in here as a series of questions as a prompter. Yes, there's some examples in there on strategic actions, but in the context of what's important, because this will be different to each council. So some examples of strategic actions you might want to ask, and these are more as a prompters. So logically making a surplus each year to fund services and new infrastructure, but is it realistic for council? So not every council is in a position to do an underlying surplus. There's some councils that do have, but don't have the capacity, because one of the key reasons for that, they haven't got sufficient funding on renewal to completely fund their depreciation. Often that plays out in an underlying deficit. So so the surplus, well, particularly an underlying surplus, may not be realistic for all councils. So it's understanding what is and what's a realistic measure. Keeping enough cash in the bank for a rainy day, that is, while we might have large carry forwards, or some councils, in fact most councils I've been associated with, and just the nature of the beef, have carry forward projects. So we generally have money in the bank left over for carryover capital, and particularly with grants, commissions, as we know, being paid in advance. But they're usually, those funds are usually committed for purposes, so that we often need to quarantine those. So is there enough of a spare cash for fund contingency and unexpected costs? It could be some major cost blow, could be a major draining issue, or a natural disaster type of. So again, it's a target might be on terms of what working capital ratio could be, or even use of, or setting up a discretionary reserve. Some councils look at quarantining budget saving, allocating budget variances to a discretionary reserve. When I say, do you have time to do this? Not every council's got the time to go back in, because this is the time of the year end, we're trying to get the annual financial statements out. We might be looking and say, okay, we actually need, what we have to do is go back, and while we're doing the year end, look at what the budget savings. This will often be a forecast savings rather than the budget, because we know if we're doing it, if we're cutting the draft budget for next year, we're looking at the forecast, which is, as we know, is if you like, it's like a new target for the from the current year budget. That forecast becomes the new norm for the current year. In this case, our 2021 forecast, and we need to use that as a baseline and then it might be a variation from that forecast. Because, for example, if we use forecast, we've got forecast savings in the current year. We might need that to balance next year's budget. That forecast becomes the new baseline. Then the issue is have we got any savings beyond that, which as a strategic action in this case would be potentially to quarantine that discretionary reserve. And it could be something like a savings to put a planned reserve to fund replacement of planned infrastructure. The issue of time to do that is being able to do that in the case of a year and over the context of the other things that are going on in year end. Key performance measures. A lot of performance measures, as we know. We have VAGO measures. They're in the budget. They're in this document. They're also, we've got some in the borrowing. The question is, what's the measures that are important to your council? Services. How do you look at services? Do you have a funding gap? What's your council capacity? I mean, a lot of councils are doing service reviews, but what have they got the capacity to maintain or even improve services? Are their service levels well defined? Do your managers, if this is just your line managers, service managers, know the impact of services? So, for example, if it was some early years program or age and disability, childcare centres, do they know in terms of their hours of service delivery, do they know the income? If they had to funding, whether it be from grants or from rate subsidy, they had to scale it up by 5% or scale it down by 5%. What's the impact of the services? How do you put that in? What assumptions do you make into your 10-year model? Do you assume in your 10-year financial model that the service levels aren't changing, so therefore you apply maybe an annual escalation that's in line with CPI, for example? What variations and what assumptions are built into those services? Again, just some examples of strategic actions questions. Borrowing. What's your council's appetite for new loans? Some councils with an appetite for borrowing, as we know, loans or interest rates are an unprecedented low level. We know what the state government's policy is on their own borrowing in terms of their main infrastructure. It's a pretty significant borrowing program. So what's your individual council? Some councils have still got a position where even in the context, and that's obviously their core, not to have or to have minimal borrowing, but is that an appetite, and how do you build that into your model? How do you address that with your councillors? Lifestyle costing is item 7, pretty important one. Do you do lifestyle costing in the capital project works program? Is lifestyle costing built into your 10-year model? For example, if you have new infrastructure and it's a new facility, there's probably two things. There's the maintenance cost on those and the operational cost. Operational cost, just putting the lights on. Does it require extra staff? I had a situation a number of years ago in the council where there was actually a new facility board built, required an additional complement of staff, and it wasn't originally built into the model, so it needed to be addressed at the time of that particular budget for the next year, rather than being built in. Now, it's a common mistake to make. It's a common one because there's a lot going on, and to try and manage these things as well. A key one for that, in fact, if there's anyone on the call from Murrindindi Council, I had the opportunity to work with Murrindindi a number of years ago, and of course with the bushfires, there was a lot of state government funding to put towards new infrastructure. A lot of the things that Murrindindi and I think the council that they wanted at the time was money to replace the road renewal. But of course, as part of the reconstruction of bushfires, there's a lot of new buildings and they're proposed. I think it was some $30–40 million. But by building in that new infrastructure comes with a cost in lifestyle, in full lifestyle costing additional maintenance. So it was going to add at the time some significant dollars to if all those buildings were built, then as per the state government funding model, then it was going to add some significant costs to the maintenance and operating cost of the budget at the time. Against this a few years ago when the fires were devastated. A few years ago, but particularly up in the Murrindindi area.
Malcolm, sorry, can I just throw a question in there?
Yeah, sure.
We've just had a question about back to number 6, the borrowings. And the question is, in the borrowing section, do we need to put or consider lease liabilities as part of the borrowing strategy?
Yeah, it's a good point. I haven't included it for completeness, but look, I guess for completeness, and because it is a form of borrowing, I don't think it's not mandatory. Again, this is a strategy document, it's a template. This implicitly we have, but I would probably answer it in 2 ways. I don't think it's not mandatory to put in, but it's what you want to tell your council and what you want to tell your reader. Logically, if leases, and I think part of the question is, and I'm just thinking out loud, does VAGO assess the lease cost in the context of a borrowing performance indicators? My understanding is they don't at this stage. However, if you can put it in, it may be prudent for completeness. Again, this is not a mandatory section and it's not in the template at this stage because, of course, again, it was a timing issue. However, I think for completeness, it would be useful to put in because it does tell the reader what your council's overall commitment to funding is and to what you actually have on the balance sheet. So about it does, of course, borrowings and leases. But having said that, Gab, it's not on the template at this stage. So short answer is not mandatory, but for completeness, it'd be useful. Happy to take anything offline if people want to follow up with further information.
Thank you. Thank you.
We're up to, okay, for lifestyle cover number 8. Oh, that's one we've covered before about, this is fund infrastructure and you're maintaining the asset intervention. So different councils will have different asset intervention levels. Or this is what the engineers said in terms of that is what condition of the roads do they have and how bad is a condition before they want to replace those roads. So honestly, if the engineers were to change their intervention level to a higher standard for replacement, that would increase the renewal because it means it would be more frequent renewal. So it's what the council's appetite and how bad does the roads get from an intervention level point of view before you do the renewal works. And then can you fund it? So, and look at some of the councils, it's just to look at some budgets and have a look at what's the renewal amount. And yes, you can add some upgrades, we know, because there's some renewal component in upgrade. What's the depreciation, which is a high level guide. And in particular, a lot of councils, and particularly some of the rural councils that have got challenged large infrastructure, a lot of roads, there is a challenge in that area. In terms of having sufficient money, but intervention levels, it's a bit like the intervention levels, what the engineers said for assets, a bit like in the previous one on, on number 5, which is the service standards. So what's the service standards that you actually have in terms of services? I used to say, but you know, probably I need to update my language. Is it a Rolls Royce or a Holden Commodore service, or is it something lower than that? In terms of what the expectation is in terms of service standards and what your council can afford. Again, last example here is fees and charges. A lot of councils and appropriately have, and this is probably covered off to some extent in the revenue and rating plan, will have a pricing policy around service delivery that says we do full cost recovery. So the question is, do you know what your actual full cost is? Because in order to do a full cost recovery, you need an overheads model. And there's a pretty useful overheads model, and the councils have done some really good work in that space. But again, it's a challenge of keeping full cost, knowing what your full cost is, having full cost recovery model that you're comfortable with to demonstrate hand on heart and say, well, yep, we are fully recovering from a pricing policy point of view. But setting those fees and charges, why do we mention it here? Because the fees and charges, and whatever your position is in fees and charges, is going to impact the 10-year model. Because what's the assumptions, and when we get to the next section, we look at assumptions, what assumptions you're making on your fees and charges? You're just assuming that it's a CPI. So they're probably example strategic actions or some questions. The examples, again, this is just the examples that we've actually put in the template. Following strategic, so this is an example of the council. I might say, council has identified the following strategic actions will support the aspirations of the council plan. Again, going back to the council plan, as that's what the whole intent is that it satisfies in the context of the community vision. Again, these are just examples. Increase investment of council's cash contribution to renewal capital. So there's a renewal capital about escalating risk. So I've just changed the language a bit, but it's the same intent about focus on renewal. Put simply, new capital works to include a minimum percentage of external funding. Now, for some councils, and particularly some small rural councils, that percentage could be well above 50%. In fact, it's a matter of a capacity to have enough money as seed funding to get government grants. As we know, there's at the moment, there's a lot of federal and state money out there to stimulate the economy, and local government have been recipients of that. So that minimum percentage could be high. It could be 50, 60, 70%, because a lot of councils, some of the small rules might say, well, we haven't got much money from rates to kick into new work, so it's got to come externally. Again, that's a strategic action and put it part of your strategic intent. Thrown in there about, as I field one about even things such as addressing climate change. Is that a priority for your council? Where do you address that? And how does that play out in the context of the financial plan? Debt funding to be applied to growth infrastructure where necessary. As we know, we tend to only apply, should only be applied to new infrastructure. Rather than, as we know, new money or new loans shouldn't really be applied to renewal or maintenance work. The last one, again, just another example that I think was being put in, and this is coming from the work we did. This is straight out of the template, and thanks for the working group. The financial plan working group, maintaining current service levels for the next 4 years to enable council sufficient time to complete a full review of its services. So what that's assuming is, if anyone looks at a 10-year model, they say, well, same service level, so years 1 to 4, which essentially the budget anyway, as we know, is really based on no change to services. So it might be more of a CPI type approach. It's not, and then the expectation in this case was we're going to have, that'll give us sufficient time to do service reviews, and we can then look at scaling up and scaling down service in the context of what we can afford. That's strategic action. I'm just going through the time, so we've got 10:06, but I'll keep going. Assumption of financial plan statements. Again, this is pretty, I'm not going to say crude, but it's a bit rudimentary. So the model, again, the template, if you like, just tells what the major line items are with a percentage increase. I know it's not as simple as that. I know this is a fairly simplified model of what your annual escalations might be, but it just helps the reader to say what those escalations are. So I probably think of this as a baseline. The starting point for that is, and we've put on there a line for CPI and growth, because growth can be a little different from CPI, but it's a case of then what's the assumption you're going to make with rates, charges, fees and fines, user fees, all of those line items, for example. For example, at the moment, because we know next year the rate cap's 1.5%, what do you put in there and what assumptions are you making? What assumptions do your model make for the next year? For example, do you take the current rate cap limit, which is 1.5, and do you assume that for the next 10 years, or do you pick a different figure? But it just helps the reader with that in the context of that. What's the CPI figure, and what's your assumption on each of those line items? For example, the statutory fees and fines, user fees, right down to employee costs. What you're assuming on employee costs, which is often a big one for growth. if a lot of the EBs at the moment, a lot of the EBs are, there's just some general feedback, but I'm getting, but a lot of the EBs around between 1.52, even though the rate cap's 1.5 for next year. Some of the EBs might be landing somewhere marginally different to that, could be a little higher. So what assumption do you put in your employee costs and in this line, and what's the growth you're putting in for that? Do you assume an escalation of staffing? Obviously, whatever you're doing on this line, employee costs will need to have some correlation to the staff numbers on the basis of are you a growth council, or what sort of assumptions you're making for that change in year. So it's things like growth, it's things like increase in CPI, and then things such as change to service levels. So again, it's a little bit rudimentary, that graph, but it just tells and paints a picture for the reader. The other thing in there we put up there is the explanation. So you'll see in the model, or I can't call it the model, it's the template, we put a draft explanation in each of those line items. So there's a commentary. So if you go to that section on assumptions on financial plan statements, you'll see there's some commentary about rates and charges, user fees, grants, employee costs. So it gives you an example on, just put some commentary on what's unique to your council's movement for each of these major line items. So I won't actually go through that time, but if you went to that section in the I don't think it's section 3, but this is the numbering I've just used for the presentation. So, but if you go through that, you'll actually see there's some draft commentary on that. So that's the assumptions of a financial plan. Just time, I'm not going to flick through unless there's questions. I'll put in the presentations, we know what the statements are. So I'm not going to go through these, as you know, because I think most people will be fairly familiar with these. That, for example, these, we know the first 5 years of forecast for 21-22 through to 24-25, that's going to be effectively the budget. That is, if you're adopting your budget at the same time, doesn't have to be. I know when we first came out from the sector and LGV, they said, oh, we'll really need to make them the same, but some councils won't if they're going to adopt in October rather than, or towards October rather than June. Their numbers here for the 10-year model is going to be different, potentially different from the budget, because they'll adopt their budget by June and then make further modifications. But again, for those councils that are going to adopt at the same time, a lot of councils, my understanding is, and if those councils have a 10-year financial model, so most councils will have a model currently that generates the 10-year numbers for their income statement, their balance sheet, and their cash flow, for example, and the capital work statement, of course. But they'll take the 10-year numbers, they'll drop it in here, and then they'll take the first, the 5 years from the forecast actual to the 24-25, and they'll drop that into their budget document. So those numbers are the same. So hopefully there's not too much sort of rework, because they'll be the same numbers. And also the councils that do that will also have their 10-year model already calculated. They use it for the budget anyway. So it's a case of them putting it in here. So I'm not proposing to go through that in great detail. So it's the income statement, again, the balance sheet, the statement of cash flows, the capital works statement. Again, that's why you should see those as pretty much the same format, look and feel as what's in the model budget. Capital work statement, and again, the statement of changes of equity, of course, it just continues on. I've only shown it down to 5 years, because you know it's a 10-year model, but really it's the same sort of methodology and same calculation which are currently doing the 4-year model.
Malcolm, sorry
yes.
to interrupt, and I'm going back a couple of slides. I was trying to work out where to jump in there.
No, you're right. Just interrupt me anytime.
Someone's just asked a question relating back to the borrowing strategy section.
Yeah.
The question is in the borrowing strategy section of the model financial plan under the performance indicators. What is the difference between the debt servicing rate revenue ratio and the debt commitment rate revenue ratio?
Oh, okay. So that's the slide further on the borrowing. So the debt servicing is interest only, and debt commitment is principal and interest. Okay, so the debt servicing, that's why the ratio of the target's different. So debt servicing is interest, effectively interest on rate revenue. Debt commitment is principal and interest on rate revenue.
Thank you.
Okay.
Cheers.
Thanks for that. No, happy to. So that's statement of changes in equity. Human resources, as we know, we're going out 10 years, and as we know, we've got 3 categories: male, female, and self-described gender. Quite frankly, I'm not quite sure what I'm going to put in the work that I'm doing at the moment in self-described gender, but who knows what happens, what it looks like out for 10 years. But I'll just might leave that one alone.
I'll jump in again with another question, sorry.
Yeah, keep going. Yeah, you're
back
right.
to your rate increase assumption.
Yep.
It would be good if we all used the same. Has there been consideration for FinPro to provide a suggested future FGRS rate increase assumption? You probably can't answer that question, but that's something that we can take to the FinPro exec to have a discussion about.
And it's a good question, because some councils I know pick up the last rate cap and use that as the basis moving forward. But it all depends on assumptions that you're going to make in the CPI and the growth. That is, I know last year, in the work we did last year, because we had because of course the rate cap was 2%. So any of the modelling that I did from last year, I based it on 2% future. Now I'm doing so, oh God, does that mean I've got to use 1.5%? That just kills off that, that just kills off a lot of income, because if we know the compounding effect of 0.5% of rate revenue over 10 years is pretty significant. Or you do the 1.5 and then go back to the 2. And what is the basis for what assumptions do you make regarding the 2, or any other percentage for that matter? I think it's in the context of what assumptions, and I guess that's why we've put in there a CPI and growth, because you generally align you expect, give or take, if the appetite for state government is, well, the rate cap is actually CPI, then that number is going to be the same. So if you're going to put 2% in the rates and charges, or keep the rates line, just leaving aside the charges, say for the 10 years, you'd expect that your CPI is going to be 2. If it's lower, then you're going to have a rate cap variation. So I appreciate that's a sector in the FinPro one, Gav, but that's my thoughts on it. So,
sorry, I've just got one other question too. In the capital works statement, do we need to put intangible assets expenditure separately so that we can link to the council's intangible assets value in the balance sheet?
I think it's whatever you're doing. I mean, the short answer for me is it's whatever you're doing in the budget is to align that, or is this a budget question as well? So whatever you're actually doing in the budget, and again, the financial plan is meant to be a high-level modelling document to show what the intent is. So I'm probably not as, unless it's going to be significant, I'm in terms of future years, for say years 6 to 10, I'm not sort of hell-bent on, you've got to get exact numbers right, because it's about showing overall sustainability. Yes, there's some compliance component. I think the general rule is try and align the two budget as much as possible. So that way for consistency. But I think in terms of particularly years, I guess 5 or 6 to 10, it's about what's the intent and what's the general direction of the council, and can they demonstrate in a financially sustainable way that they're satisfying the aspirations of the council plan. Not a specific answer, but I think is trying to take a bit more of a high level view, particularly for years to 6 to 10, but also if it's years 1 to 4 in the budget, align it to whatever you're doing in the budget, I think.
Thanks. No more questions at the moment.
All right, 17 past, so I'll keep going. So that's the planned, I won't go through a planned resource expenditure. We know what that is, and we just have to come up with some numbers. But what I can say is about putting 10-year numbers on staff resourcing. Try and just align it, because you've got the expenditure and also have the staff numbers for 10 years, is have some correlation between that and the back here between what assumptions you're making in the employee costs. You're expecting a significant change in this level. If you are, then it'd be prudent to reflect it to reflect it in the staff numbers and obviously the staff expenditure. There's a line between the staff expenditure and, of course, the employee costs. Financial plan statements, that covers that. The performance indicators I won't cover too much because this is really the 10-year view of what we're already doing in the budget. Again, demonstrate financial sustainability. So the whole purpose of having these is to actually show that, you know, it's that whatever you're actually doing, I mean, it might be fine to put in the aspirations of council plan and put a whole lot of extra capital, for example, because that's what the community wants. But if you haven't got a hope in hell of funding it in the council plan, why put it in? Because so the intent is to say, does it reflect your council plan? If it's, for example, a lot of new infrastructure, and how are you actually funding that? So the performance indicators is the actual intent or the demonstrating to the council and to the community that you can actually fund by having sustainable financial performance indicators that are hitting the targets, and a lot of them have targets that are either VAGO ratios or other council targets, that they're actually sustainable and they can actually be funded by having those expenditure projects over the 10 years. So that's the key thing. So allows the reader better understanding of what the debt is, for example, liquidity, and as I said, these are the ones in the model budget. So I'm not going to cover this too much, other than to say they're in the budget anyway. Borrowing strategy. Again, this is really just a baseline. Some councils that have previously had, or before we had this, the mandatory financial plan, they've had some fairly robust borrowing strategy. So we've probably picked out three things. We've probably picked out, said one, tell us in here, what's your current debt position? How much debt have you currently got? And there's an example of commentary if Council A has such and such a debt, and that debt is to do a range of stuff. So we've got some current debt and we're using it to fund a range of construction. Now, that example commentary I've actually taken and put ABCs and XYZs from a Metro Council. So I won't mention their name, but I think that they might be able to recognise it. Oh, that looks a bit familiar, but with some change to the commentary. But that's just an example of demonstrating to the reader to say, we've got this debt currently as a baseline, and this is what we use it for. Second part is, what are you going to do next on future borrowing? Are you going to borrow or take out additional borrowing, say for new capital? And this little table is really, again, to say, what's that look like over the 10 years? So, you know, it's a pretty straightforward to say, there's your opening balance plus new loans. Take off principal payment, gives you a closing balance. Logically, the closing balance should then align to your balance sheet. So if you can link that back to the balance sheet, the principal repayments and the loans and the plus new loans will be in the cash flow statement. And of course, so it's a good little reconciliation. You can use this also as a reconciliation for debt between cash flow and balance sheet. And for completeness, we've included in here on the interest payment. So you can actually use the interest payment here for the income statement. So it gives the reader to have a quick look, all in the one spot, about new and existing, what your current loans are and what you're proposing for the future, and what does that do to your total loans. So that's the future borrowings. The third section will, if you do going to have future borrowings, are they sustainable in terms of the ratios? So this is putting the ratios. Now, these targets, for example, the indebtedness to own source revenue is I think that's one of the VAGO measures, but that's for what I call the yellow zone. So if you know, in the VAGO, they've got the green below 40, amber is 60, and red is 80. Then the discussion, I think, in the working group, we landed on putting 60 because some councils had a bit of an appetite to go a bit more into above the green zone and had a bit more of an appetite for more borrowing. This is an individual council by council assessment. Is your council have it? So this is by no means mandatory because obviously from a VAGO perspective, it's outside the green, the green zone of having 60%. They're pretty conservative. Again, the debt servicing, which is interest on rates and principal and interest, they're pretty conservative, 5 and 10%. This is a pretty simple measure, total borrowings on the rate revenue. I've used that one before in another council to actually do a borrowing strategy, and we actually used 40, 45, 50 and those, and actually said, what is the impact on those ratios by different appetite for borrowing based on the context of whatever new capital that might want to do. Again, then explanation on each of those ratios. Describe how the ratio performs against the target over life. That is, if you're going to have new borrowings back here, you've got the current debt, you say, yep, we've got an appetite for new borrowing, that's what it looks like. This measure is to say, well, these measures are to say, well, how are they stacking up to the target? So ideally, whatever the percentage is in here, you're to try and keep below those within those targets, because that's what's the appetite for your council in order to be sustainable, and your individual council's appetite for borrowing.
Malcolm, sorry, quick question again.
Yeah, yes.
For the interest payments, do we need to disclose the capitalised interest payment or just the interest payment in operating expenditure? Is the question? Yeah,
well, again, this is not a mandatory. I'm thinking back to the compliance report, but I don't think there's anything mandatory in here. I guess it'd be consistent with, because of course, if you're using this model to align with your budget and you're then comparing budget to your actuals, what are you doing against your actuals for your annual financial statements? I think that would be the answer. So I don't think there's anything mandatory in here, but if you've got a particular policy on how you're treating that and how you're treating your actuals, because remember, you're trying to get correlation. You're trying to get correlation between a 10-year model. Just think about what the financial plan is, and I'm going to chunk this up a level, what I call up a level, because at a high level, this is a modelling tool rather than a detailed compliance tool. So whatever you're doing in your annual financial statements, then I thought you need to be, ideally, if you can, be consistent with the budget and the 10-year model, because the budget's meant to be the 4-year view of your 10-year model, the financial plan, and the idea is to demonstrate that it's, I guess, correlates back to your actuals. So what do you mean, actuals being your annual financial statement? So what you're doing with annual financial statements, probably try and make them as consistent as possible. But having said that, this is a high level view, so I hope that helps. So I think get that correlation. Okay. Reserve strategy, again, these are only examples. So I've picked 2 of the examples of reserves. Public open space reserve is, a lot of councils have, as we know, is because that's a mandatory or a statutory reserve. So I've just picked a mandatory and a discretionary reserve. Again, these are just examples. So what we're recommending, or in the template, to say, tell the reader about what the purpose of the reserve is and what are the reserve movements, what's going in and out of the reserve. So when they look at the actual numbers, so again, here's the numbers: public open space, opening balance, transfers to, so what's going in, so it adds to the reserve, transfers from, reduces from reserve, of course, closing balance. So opening balance plus minus new closing balance. So when you do that purpose, what do you have a reserve? And then what are those movements? For example, in the case of open space, it's contributions income from subdivisions, it should read, in lieu of 5% public open space requirement. Transfers or outflows usually goes, or often goes to, not always, but capital projects. So that's an example of the public open space. Plant reserve, again, this is a discretionary. Not all councils, of course, have this, but some do, is to put money aside to replace, for example, their heavy plant. Set aside funds to replace from heavy plant. Again, some councils have said, well, where the movements, where do we get the money from? Well, we get the money from, or could be, again, this is a case-by-case basis, sourced from budget savings in, say, maintenance works or depot operations, I might say, or any savings we get within the quarantine, put in the plant replacement reserves. And then, of course, if the money transfers from, it transfers out, to actually fund the fund the acquisition. Again, that's for reserve use projections. Again, we've put the example 10 years to think. We've put the template in, what that looks like, restricted, discretionary, and then a total. So we've only put examples of 2 in there. I've probably got about 5 minutes or so. You happy with that, Gab? I'll just keep going through if people are happy for me to keep doing that. So I'm nearly at the end. The only other thing I wanted, so that's the key things on the, going back to the document, apart from the introduction, they're the 2 things that, that we talked about back on here: the policy, the strategy, the assumptions, financial plan, performance indicators, borrowing and reserve. There's only 2 things I wanted to cover off. For me is, again, we mentioned very quickly, is community engagement. What are you going to do? Again, this is in the model, it's in the guideline. There's no one size fits all. I'm not an expert on community engagement. What I do know is, what are we actually doing for community engagement? In the terms of the section, the old section 223, this was probably at the low end. Is, well, we went out, we asked the councils for their feedback, that is, make submissions to the budget. Then the councils assessed it and told them the input, how to affect the decision, whether did they implement anything out of the 223 process and submissions. So that's about the old, that's where my assessment, I think, where the 223 process is. Some councils have gone a different direction, have a higher level of engagement that's between involve, collaborate, and even empower. But whether we've got to that, whether that's something better, but again, this is an individual council choice. It's only in there for completeness. But if councils that have got adopted a community engagement policy, you need to have some form of community engagement on the financial plan. The last slide is just other matters. Now, this has come out, but I'm just going to have about if there's any interest, to give them a call. I've actually, I've had some discussion or question about embedding formula calculations in the policy statements, because that's got formulas, the performance indicators, and the borrowing strategy, or also the I guess the model budget doesn't do it. LGV's position on this is, well, they don't want to do that particular work, because in case they get it wrong, and it's really up to councils to take responsibility for those formula calculations. Again, if people want to contact, again, this is a pro bono, so I'm happy to, that's for a for just as part of a service to the sector, if there was any interest. So it's sort of developed been developing a financial plan, but model that I'm working on has got some embedded formulas in it. If again, they're fairly generic. If any council's interested in that, happy to give me a call, and I'm happy to take that on board. The only other final thing again is LTFP 10-year calculations. Most councils do have some 10-year model. There's some pretty good models out there to do that. I know there's a few councils who do not have an existing LTFP 10-year model. I've actually been able to they've taken the 4-year model, and with using the escalation factors, have created a 10-year model. Again, happy to share that as part of a service. If that's of any benefit to anyone, just give me a call. Because I've actually had an experience where I've come across where there hasn't been a 10-year model. Again, it's not ideal. I certainly recommend, if you haven't got a 10-year model, to actually get one and use that as a more robust approach. Again, this 10-year LTFP 10-year calculations is only for the purpose. It's not a replacement of a 10-year model. It's just to get those councils over the line that don't have a current 10-year model. So happy to share that if that's any value. So yeah, that probably covers it off. Thank you everyone for attendance, and I've left there with Albert Einstein if there's any other questions.